I'm Erica Bigley, the Vice President of Communications for Achieve, and I'm joined by Brad Stroh, who's Achieve's co-founder and co-CEO. Good morning, Brad.
Hey, Erica, good to be with you.
So there's a lot going on in the economy and economic news, and I want to talk to you about it since you've been in this business for over 20 years. I think you've got some interesting insights. FICO put out an announcement that for the first time in a decade, the average FICO score had dropped. Now, granted, it only dropped by 1 point, but I want to understand, is this like a canary in the coal mine moment? Is this some sort of bellwether? What are we supposed to discern from this first time in a decade drop?
It's to some degree a canary in the coal mine. There's many layers to this particular canary. There's probably more of a flock, and you have to unpack this into the individual consumer segments and what are the impacts around, what drives the FICO score and what's causing this the first time in a generation of a decline. I think, coming out of the pandemic, we see a lot. And from my perch, being the CEO of a consumer finance business, to be on a board of several fintech businesses, I do have a unique view of the US consumer and the US household. And I would say the US household is stressed. There's a bunch of underlying variables to that we can get into, but we're at peak consumer debt, 17.5 trillion of consumer debt at a time that interest rates charged on non-mortgage debt are the highest they've ever been in history. And you probably saw this stat as well, which this is going to conflate with the FICO degradation, which is the amount of interest paid on non-mortgage debt over 560 billion is now at or about to pass the amount of interest paid on mortgage debt, which is just mind-blowing. It means you've got over $1 trillion of annual interest payments from US households, by far the most ever consumer debt we've ever had, at a period of time when inflation continues to hit the pocketbooks in a very regressive way of lower income and middle-class families. And the alternatives for consumers to deal with that debt when interest rates are high and you don't want to touch your 30-year fixed, which is the logical thing, it means this background debt, auto, student loan, credit card, buy now, pay later, that continues to build. And when inflation continues to hit the monthly pocketbook of American households and put a lot of stress on the cash flows of the families dealing under the burden of those debts, without these alternatives, and when credit tightens, I think FICO migration down is the symptom of all of this root challenges that American households are facing, driven by debt, inflation, rising interest rates. We just saw CPI print hot today. And I think that's part of what we're seeing in this FICO migration down for the first time in a generation.
So new data out, CPI on the rise again. And a lot of the commentary already is the Fed still feels like they're going to stay status quo with the plan. No expectation that they'll cut rates any sooner than they would have predicted. So what should consumers be thinking about when they see CPI increase month over month like they are right now?
I think there's a bunch of layers to that, Erica. So CPI, just to really simplify, is the cost, it's consumer price index, is the cost of stuff that we all buy. The reality that came out, the print was 0.4% increase, which annualizes 4.8%, obviously well above the Fed's target of 2%. As long as inflation continues to be high and run hot, it's going to be impossible for the Fed to cut rates and the expected 3 rate cuts that the market got out in front of the Fed and thought were going to come this year. At the individual household, the things that you see are double-digit annualized increases that are sticky in costs of things that are very regressive. They hit middle-class and lower-income families much harder than wealthy and affluent families. Auto insurance, rent, groceries, gas, travel. Those are the things that those prices they're just remaining sticky and high. They've come down from peaks. The rate of change has come down from the peak, but the rate of change continues to be significantly positive at this point, higher than what the market and what the Fed was hoping. And they're just sticky and stuck at high elevated rates, which means consumers that are struggling under the weight of 17.5 trillion of debt, high interest rates, and this sticky inflation, it just means month to month cash flow constraints are even harder, which puts the Fed in a very tough position of they want to alleviate the burden. They want to lower interest rates. They don't want to force the economy into a recession. But at the same time, they can't lower interest rates when inflation continues to run hot, which is above their target level of 2%. And these sticky inflation numbers continue to hit the households that we serve. they got to hold on. You got to budget. You got to be very responsible around cash flow, manage your debt, and dealing with these higher interest rate environments that we're stuck in right now.
We've got some great data that's coming out, including some data about how people are looking at the economy, how that's impacting what they're thinking about at the polls. There's obviously a big election coming up in November. Over 70% of consumers are reporting that they're living paycheck to paycheck. 70%. We've got 54% reporting less than $1,000 in their checking account. 40% saying they've got less than $1,000 in savings, and 68% with no emergency fund whatsoever. And the big portion of those are saying the possibility of a recession is looming, but they don't have any preparation for any of the fallout from it. Why do you think that people are predicting that the economy is going to continue to be tight like it is? There is the potential for a recession, and yet the average consumer is not taking any steps to preserve any savings, checking, or emergency.
Well, I'd say I love running a business and I love helping the consumers that we help, and we do see it. I generally try to stay out of politics. That's not a fun arena for me, but you see it. And you see Americans that say Bidenomics, they feel that it isn't serving them. But the reflection of that is that 70% of American households living paycheck to paycheck, the 17.5 trillion of consumer debt, interest rates at a generational high. Those things are hitting these households. So you say they're not doing anything. The reality is they don't have a lot of options to do things. You don't really want to refi your mortgage and double your interest rate, which would double your monthly payment. You don't really want to move. You're sort of stuck in your house. So you're ending up with these households. You asked earlier, is FICO degradation a canary in the coal mine? I don't think it's a canary. I think what you have is a flock of American households. And when interest rates are at an all-time high and home prices are at an all-time high, you've got just massive disparity in wealth and inequality. And these households that are showing up in your statistic of 70% of households living paycheck to paycheck, really no sustainable savings that can get them through a 3 or 6 month, period of disruption. They don't really have great alternatives. On the positive side, we talk about soft landing. You hear economists talk about a soft landing in economic prognostication. Unemployment remains very low. So this is not an unemployment-driven stress. It really is a cost, which then that cost disparity of lack of affordability translates into financing that lack of affordability with debt, student loan debt, all-time high, credit card debt, over $1 trillion, all-time high, auto loan debt, all-time high. And then typically the responsible thing is you would refinance that into a lower cost of debt repayment vehicle with a much lower payment, a mortgage. You're seeing huge shrinkage in the amount in the refinance volume of American households. And so they're just struggling under the weight of inflationary pressure, cost of living, and this huge amount of debt with record high interest rates. The reality is they're just trying to weather the storm of inflation, cost of living, record debt, high interest rates, and there's not a whole lot that American households can do.
If we're expecting people to continue to weather this storm, and we think people are going to have to tread water for another, couple of quarters or so, if you had to give the everyday consumer one piece of advice for how to get their financial picture a little healthier, not to solve all of the problems, what's one simple thing that consumers should do to get themselves on that first step?
Well, this isn't just for this economic time. I'd say this has been for the 2 decades of us running Achieve and helping American households is have a plan. Now, that plan today is more important than ever when the cost of living is so high. That plan typically starts with a budget. Make sure that you're not over your skis, that you're not spending more than your income comes in. If you are, that you're trying hard to figure out a way to manage your discretionary expenses to get to positive cash flow and positive savings every month so you can deal with a 3 and a 6 month economic emergency. And then the liability side and balance sheet side is be very aware of the cost of debt repayment in this window of time when interest rates are so high and debt is so high. If you are struggling under the weight of a lot of debt, you're going to have to come up with a plan for how to manage that debt repayment. In a world where you might not want to refinance, there are alternatives. If you're a homeowner with a lot of trapped equity, you've got HELOCs. If you have a very high FICO back to FICO degradation. You can apply for personal loans that are lower interest rates than credit cards, but still relatively high rates. So be very responsible around ability to repay and your ability to make those monthly payments. And then if you're stressed, to look at stress relieving options for debt. But fundamentally, I just say, Erica, have a plan, cash flow, debt management, and know that most of 70+% of American households are navigating this. You're not alone, and you'll get through it.
Brad Stroh, our co-founder and co-CEO of Achieve, thanks so much for chatting with us this morning.